Hello fellows, welcome to my channel. This channel is created for educational purposes only, dedicated to people who want to learn how to trade. Either you want to trade stocks, crypto, commodities or Forex. You will find high quality educational material. Either you are a beginner, advanced or an intermediate trader. For viewers that want to see more action and how we apply the theory in real trades, you can visit our live channel. Here we are trading our live account and applying the theory, proving that it can be done while all trading profits go to our subs. However, as a beginner, I do not recommend starting with any real money. Trading is very risky and challenging. However, a risk comes always with a reward. You will find 50 videos to understand the theory, 12 sections. Each section is a playlist consisting of several videos. I do not recommend skipping chapters and trying to take classes from the beginning. We are using verified sources to provide the most accurate information. Remember, this is an educational channel and you will always trade with demos to avoid the risk. Make profits in the market is not the easy passive income you have in mind. The entire material is the same as you will find in most trading courses. The material is totally free and you don't have to pay any guru to learn generic information or waste thousands of dollars. So if you want to support us, subscribe, like and leave a comment for the YouTube algorithm. And you can post your progress in our Facebook page. Thank you very much and trade safe. There is a trading strategy that can make money if the price stays exactly the same for a long period. Welcome to carry trading, the closest you can find in passive income that really works. A carry trade involves borrowing or selling financial instrument with a low interest rate, then using it to purchase another financial instrument with a higher interest rate. Carry trading is a topic we need to cover. This part will also help you to understand the rollover fees and how to use them in your advantage. Solely trading with carry trading is not what we are expecting you to do. However, you will find several applications and uses, especially when you hold your position for longer periods. In simple words, carry trading involves borrowing money in a currency with low interest rate and investing in a currency with a higher interest rate. We aim to profit from the interest rate differential between the two. One of the best examples is the USD GPY pair, as the interest rates are keep going higher for the USD, but for the GPY they are extremely low to negative. As the rates policy is not related to this episode, indeed there are countries with negative interest rates and some other exotic currencies with very lucrative interest rates. Carry trading involves selecting currency pair with significant interest rate differential. Another example, if the Japanese yen has a low interest rate and the Australian dollar has a higher interest rate, trader might choose the Australian GPY currency pair. Go long with the high yielding currency. You will buy the high yielding currency, in this case the Australian dollar, using the borrowed money. Go short the low yielding currency. Simultaneously, you will sell the low yielding currency, the Japanese yen, to complete the currency pair position. Earn interest rate difference. Since you as a trader borrowing money in a low interest rate currency and investing in a high interest rate currency, you will earn the difference between the interest rates, known as the carry. Rollover costs. Carry traders often hold position for an extended period, paying or receiving rollover costs each day based on the interest rate differential between the two currencies. It's important to know that carry trading is not without risk. Currency value fluctuates and exchange rates can change unpredictably, affecting the potential profit or loss for the trade. Additionally, geopolitical events, economic indicators, and changes in central bank policies can impact interest rates and currency values. Depends on the period and the circumstances, you will be amazed on the rollover fees by exploiting the difference between exotic currencies. For beginners, we do not recommend to use carry trading, but we will see how to optimize your trading decisions, either by holding a position longer or leaving earlier. We will give a step-by-step example of carry trading in currency pairs. Keep in mind that the rates do fluctuate, so this will change based on each country rates. We are keeping a trade for more than a year and you will see the example with real numbers on how rates will either be favorable or adverse. In this example, we will use the USD GPY pair. The USD GPY exchange rate for the moment is 150. In simple words, 1 USD can be exchanged for 150 JPY. The interest rate for the USD is 5% per year. On the other hand, the interest rate for the JPY is 0.5% per year. In FX, we always use leverage, so the same we will do here. We will use a leverage of 200 to 1. Let's say you have 1000 to invest in this carry trade. With 200 to 1 leverage, you can control 200,000 of USD. If we buy the pair, means that we borrow JPY at a low interest rate of 0.5% per year to the value of 200,000 USD. We bought actual USD dollars to get these juicy yearly rates. With this trick, we gain 10 times more interest value in our money. So our initial investment of 1000 USD, and by using leverage, we are getting interest of 10,000 per year. Additionally, we paid 1000 per year for the JPY value that we borrowed. So we have a net profit of 9000 USD per year. In simple words, what we expect to get is approximately 24.5 USD per day. Not bad, right? In this example, we make a total profit of 9000 USD per year from the carry trade, which includes the net interest gain and the favorable exchange rate movement. Keep in mind that this is a simplified example. The potential risk is that since you are holding a long position in the pair, the exchange rate between these two currencies might start dropping significantly, so your gains won't be enough to cover the pair's fluctuation. In later episodes, we will see more advanced techniques, so stay tuned. Based on the example we gave above, we have already understand some major flaws of this strategy, and later we will explain some pros and cons. Carry trades work best when investors feel risky and optimistic enough to buy high-yielding currencies and sell lower-yielding currencies. For big boys, carry trading is a standard method. However, for retail traders like us, it's not so viable option. There is a huge trap as weak currencies tends to have significantly higher rates. So if you try to apply the method, you will fail dramatically. The reason is very simple. Weaker economy currencies depreciate at insane rates against stronger currency, no matter what is their interest rates. We need stable market conditions. Carry trading thrives in relatively stable market environments. When markets are calm and not experiencing significant volatility, the interest rate differential becomes the primary driver of profits for carry traders. In stable economic conditions, central banks are more likely to maintain consistent interest rate policies. Carry trading is more effective when there is a substantial interest rate difference between the two currencies in the currency pair. You as a trader should be able to earn significantly more interest on the high-yielding currency that they pay on the low-yielding currency. Carry trading may also be influenced by interest rate expectations. If traders expect interest rates in the higher-yielding currency to increase or remain stable, while rates in the lower-yielding currency are expected to remain low or decrease, it can create an attractive carry trade opportunity, like the USD-JPY pair we explained. Favorable exchange rates movements, besides earning interest rates differentials, carry traders also benefit from the exchange rate of the higher-yielding currency appreciates against the lower yielding currency. This can lead to additional gains when covering the profits back to the original currency. So, as the expectations for the currency pairs are increased, that the rates will be increased too, you also get benefits as the currency will become stronger. On the flip side, carry trade may not be effective under certain circumstances. For instance, when a country's economy's outlook appears weak, investors might hesitate to take on its currency as part of a carry trade. This hesitation becomes particularly evident if the market anticipates that the country's central bank will be forced to lower interest rates in an effort to stimulate its struggling economy. As mentioned before, higher interest rates are generally associated with weaker economic conditions, which makes carrying out such trades less appealing. Carry trade also tends to falter when risk aversion is high. During periods of elevated risk aversion, investors become less inclined to engage in ventures that involve higher yielding currencies, instead favoring the safety of lower yielding currencies. In such situations, the focus shifts from seeking higher returns to safeguarding capital and ensuring a reliable fallback plan in case of unfavorable outcomes, such as job loss or economic downturns. To put it simply, individuals facing tough economic conditions like a recession are likely to opt for low-paying yet secure investments rather than seeking higher yield. The priority shifts from finding yield to preserving principal. This phenomenon can be attributed to a high level of risk aversion, which refers to the tendency of traders to offload their positions in higher yielding assets and shift their capital towards safe haven currencies during time of uncertainty. In these circumstances, investors often search safe assets like the US dollar, the euro, or GBP, which offer low interest rates but are considered stable and reliable. This behavior contrasts sharply with carry trade strategies, as the influx of capital into safe haven currencies causes their value to appreciate against those with higher interest rates. As a result, carry traders may prove less fruitful during periods of economic uncertainty and heightened risk aversion. Carry trading may not be suitable for individuals who prefer shorter time frames in their trading approach. Usually, new traders are trapped in the daily range. When operating within the daily range, carry trading might not find practical applications. However, for those involving as traders and considering longer time frames, it becomes a viable option. It's essential to remember that your trading strategy should be adaptable to all time frames, as a promising trade opportunity in the daily range might present itself unexpectedly. Use your capital on a trade for a long period limits your trading opportunities. A faster and more easy executable trading plan while using lower time frames might be more viable. Suppose your analysis indicates a significant potential breakout with a substantial risk-reward ratio. Having done your research and studied our series, Trading Along with the News, you anticipate interest rates to rise. In such a scenario, your position could span several weeks or months. By applying carry trading principles, you can identify additional favorable conditions to proceed with your trades. If there are differences in interest rates, you can benefit from these discrepancies. It becomes an extra confirmation to execute your trades and hold them more than a day by following your trade in the desirable side. Many new traders do not incorporate carry trading principles into their strategies. Moreover, it's crucial to bear in mind that for carry trading to be effective, you require noticeable rate differences and periods featuring high rates. As tempting as it might be to pursue high rates in weaker economies, this can be a costly mistake. To ensure success, it's essential to enter markets with low risk and a stable political, social, and economic environment. Liquidity risk presents a significant drawback. When you commit a certain amount of capital for a long period with uncertain outcomes, there is a chance that prices may not move in your favor, leading to the possibility of your position being liquidated. Carry trading can be served as an additional confirmation provided you are willing to maintain a trading position while it's moving in your desired direction. That's it. Go back, repeat the chapters you are not sure, and you will find your name in the Arintra supporters. Help us to launch it. So that's it for now. Help us to make more content and trade safe.